Deferred taxes. Recall from our earlier discussion of deferred taxes that for the purpose of reporting financial statements to the public through the SEC, companies prepare their financial statements in accordance with the U.S. GAAP, while also preparing financial statements to the IRS for filing tax returns. The differences between GAAP tax expenses and IRS taxes payable are recorded as deferred tax assets and liabilities and stem, for example, from differences between revenue and depreciation assumptions under GAAP and the IRS. We have learned that deferred tax assets are created by tax code when taxes payable to the IRS are anticipated to be lower than the tax liability anticipated on the GAAP financial statements. A deferred tax liability is created and reported on the balance sheet when an asset or liability is valued differently under GAAP financial statements than it is on the company's tax returns, and that difference results in a greater tax expense on the financial statements than accrual cash taxes payable on the tax return. By far, the most common way that deferred tax liabilities are created is because companies use an accelerated depreciation method, or MACRS, in their tax returns versus the straight line method for financial reporting on the income statement. This treatment of depreciation almost always results in a deferred tax liability. These differences are expected to reverse themselves, such as they are temporary differences, and the result in future cash outflows related to the payment of taxes. A deferred tax asset is an asset on a company's balance sheet that may be used to reduce any subsequent period's income tax expense. Deferred tax assets can arise due to net loss carryovers, which are only recorded as assets if it is deemed more likely than not that the asset will be used in future fiscal periods.